Hey, wanted to share with you a story of how we did our first syndication deal and how it almost didn't get to the finish line. I'll talk about that in a couple minutes here. But basically, we had started in real estate like most people do. It was just me and a buddy, and we went after our first single family rental. This was roughly 8 years ago. We found a foreclosure deal. We bought it cash at auction, and then we did a full gut rehab, made a lot of mistakes, but did end up doing a cash out refinance, kind of utilizing the Burr method that is so well known, and we were able to pull out some cash and then move on to the next deal. So that's how we got our start. But as we've scaled over the years, we got to a point where me and my buddy were at 40 units. Really just two of us. We did have a couple partners in one other deal, but we had grown to that point, but we were pretty tapped out, both cash wise and just time wise and things like that. But we wanted to do more deals and bigger deals. So specifically, we wanted to get into bigger multifamily because we just like that asset class. We understand it. And for us, what we had to do, we had to jump through a few hoops first because my partner is a financial planner, and there's something in the financial planning industry that keeps people from being able to basically sell other investments outside of like securities, stocks, bonds, mutual funds, things like that. It's called selling away. And so that was an issue. So it took him 6 months or so to jump through a ton of hoops through several different states and things like that to become an RIA, or a registered investment advisor, where he actually could sell real estate securities. And I'll talk about what that means in a minute. But about a year and a half ago, we decided, yeah, we're going to do this. And so what we did is he went through all those hoops so that he could do that. We set up a company. We called it Missional Capital Group. You can find us at missional.group. But we added a few additional general partners to the mix, which helped us not only on the operations side, but from the perspective of bringing in some other talent, so to speak, and broadening our network. Because when you're doing a syndication in particular, you're raising funds. And so you're raising, most of the time, millions of dollars from people. And depending on how the fund is set up, it can either be a 506B or a 506C, which I'll get into in a second. But you're raising funds generally from people at first. And so that helped expand our network. So at the moment, we have 5 general partners, myself included. And what we did last summer is we identified a property that came through our property manager, who we've already been working with for 7 years. It was a 55-unit apartment complex, really great location we've already been in for a long time. And it was mismanaged, and it was direct to seller. So we had a couple advantages here. One, operationally and from a management standpoint, we knew that even though they had vacancies and things like that, we would be able to fill those rather quickly. And one of the questions I asked when we were doing the walkthrough, once we were under contract on this property, was, how long is it going to take to fill these 7 vacancies? Because 7 vacancies on a 55-unit property is quite big. And so I was a little concerned about that. Our property manager said he could have 5 of the 7 filled within 30 days. And he actually filled all 7 within 30 days. So that was really good to hear and good to find out, once we did close on it. But we did have some challenges, like I said, like we almost didn't close on this property at all. We almost had to let it go and lose our earnest money, which was substantial. I think it was $50,000. So how this kind of worked, with a syndication, if you're not familiar with the process, it's really pretty simple from, just a 30,000 foot view. Really what you're doing is you are pooling other investors' funds with your own, going after a property and then developing some sort of split between the investors and then the operators of the property. and everyone wins in that sense. So, you'll see splits all over the place in the syndication realm. You might see 70-30, 80-20. You might see different acquisition fees or management fees, things like that. We kept it as simple as we could. We had an 80-20 split, although we did have two share classes. So we had an A class and a B class. And the higher tier class did get a more favorable split. They had an 85-15 split. The other share class had an 80-20 split, which means that they get 80% of the cash flow plus 80% of that upside if we ever do something like a refinance or a sale. So with this being our first syndication deal, what we had to do, we had to find a securities attorney, because technically what you're selling is a security. And what that means is it's a Regulation D filing, and you have to go through that securities process. It takes a little bit of time and it takes quite a bit of money. I think we spent roughly $17,000 on attorney's fees just to even set everything up. This was even before we bought the property. So there's definitely some risk on our end going into it, but we knew that this was the direction we wanted to go. And so what we did is we went through that process, and then we started raising funds from investors. Now, this particular deal was a 506B, which means we cannot advertise it. It can only be friends and families and referrals. It has to be people that you have a relationship with. Now, with 5 general partners, we have fairly extended networks. We invested ourselves in the deal, and then we reached out to friends and family to invest alongside of us in it. So what that looked like is we had a $20,000 minimum to invest, and we were raising about $4.5 million. Actually, it was a little bit less, about $4 million for this particular one. So our thesis in this case, because of the market, it's been a very high interest rate environment, and that makes it very difficult for deals to pencil. Well, the way to make a deal pencil is to put more money down. And so what we did is we put 50% down, and then, got debt for the rest. And that's kind of where the rub lies with this one, where we had some difficulty close to the finish line. So we raised 50%, and we were 2 weeks away from closing, and the lending institution we were working with, they backed out with 2 weeks left. So here we have $50,000 on the line, that had already gone hard, which just means it's non-refundable at that point. Plus we had our $17,000 in attorney's fees, plus all of our time into it, and all these investors expecting us to get this deal to the finish line. And that was all at risk at that point. So, we were obviously frustrated and concerned, and we only had a little bit of time left, and we had to shift very quickly. We reached out to a couple more lenders. We ended up working with a lender that we already had a relationship with. And while the rate wasn't as favorable as the other bank that did not work with us, we were able to get the deal to the finish line at the last minute. And so all this to say, this was our first syndication deal. We were able to pay out distributions within the first 3 months of getting started. And what we like about our approach is it's a very risk-off approach. We want to buy assets that are relatively new. This one was about 10 years old, didn't have any major CapEx or maintenance considerations. It was really more on the operational and management side. The seller was a builder, a developer, and his daughter was managing the property, and we could tell that she was not a professional. And so we knew that we could come in and operate it more efficiently and in a better manner than she was. Plus, we had a lot of delta between the existing average rents and what the market rents were. I think the average rent that they were charging was around $925 a unit, and we knew that market rents were around $1,200. So since we've owned this for a little over half a year at this point, we've been steadily increasing rents as we have turnover within the units, achieving that $1,200 a month rent. So that adds a lot to the NOI, or the net operating income of the property. But yeah, there are some surprises, obviously, like with the lending, and it was difficult to raise funds, especially for the first deal, even though we had a decade plus of experience and had a really good track record. This particular way of syndicating a deal obviously was a little bit new to us. So we learned a lot, and we actually did, a second deal just a few weeks ago, and I'll share another video on that in the future. But if you're looking to get into syndication, or you're looking to be like a limited partner and passively invest along a syndication, I would just recommend educating yourself on the space. One of my favorite books, one of our favorite resources that we actually hand off to all of our investors is the book by Brian Burke, the Hands-Off Investor. It's a great resource for both GPs and LPs. And so I'd highly recommend you start there, so you know how to vet deals, how to vet partners and opportunities and things like that. But if you do have any questions, or you just want to stay in touch with us as we're building out more deals and opportunities, just head over to missional.group. The link is below, and sign up for our newsletter. Totally free. Hit you up once a month. We'll let you know what's going on in the local market. And when we do have new opportunities, we will let you know what that looks like and be able to send you some more information and even hop on a call with you if you so desire. All right. Hope you guys are well. Talk to you soon.